So if investors suffer from systematic and identifiable decision-making biases, do those biases translate into the market? Do they create opportunities that savvy investors can potentially exploit? And can advisors help their clients to capture some of these benefits in the way that they invest? These are some of the questions we're going to be addressing in this module. Now, to cut to the chase, the answer to some of these questions is yes. There are systematic biases, for example. So if you look at the traditional financial models of the world, the capital asset pricing model, for example, well, really it's an investment's beta that should be really the only risk characteristic that warrants an additional return. However, there's much research that shows that other things can also be important. There are systematic anomalies or other risk factors, other things that can drive a return. Now, the value effect, momentum, the quality effect are three examples of some of these sort of systematic other things that are relevant for investors as well. Now, it's not to say these are the only three things, and it's not to say these things are necessarily the only ways that you can invest successfully, but they are three big things that have well-documented research backing them up over long periods of time in multiple markets. And they are three things that all link to or have underlying causal explanations that are linked to the psychology of decision making. So we're going to look at some of that psychology during this module and say, well, what is it about investors' decision making that can lead to some of these effects? And that hopefully will give an advisor a greater sense of why these things exist and whether they are reliable indicators of the sorts of things that they can exploit when they're helping their clients design portfolios. But if these things do exist, why isn't everybody already capturing all these benefits? Why aren't they arbitraged away so there's no benefit remaining? Well, the answer to that is that there can be a number of behavioural and practical barriers to capturing some of these benefits. And we're going to be looking at some of those barriers in this section as well. It can be difficult and uncomfortable for a client to actually invest in a way that is aligned to some of these sorts of principles. So we're going to be looking at why that is, and what are some of the strategies advisors can use to help overcome some of those difficult behavioural barriers.